Hello and welcome to this podcast episode, which is a first for us because it is a collaboration between the Freshfields No Worse Off podcast and the brilliantly named Infra a Penny, which is hosted by Sequoia. I'm Lindsay Hingston, head of London restructuring at Freshfield. What are we going to be talking about today? Well, 5 years ago this month, July 2021, Boris Johnson, however many prime ministers ago, 4, 5, lose track, cut the ribbon on the new headquarters for Bulb Energy, which was actually just down the road from where we're sitting now on Bishopsgate. And 4 months after that, in November 2021, Bulb became the first company to enter into Energy Supply Company Administration. And its parent, Simple Energy, entered into normal Schedule B1 administration at the same time. So at the time, that was expected to cost the UK taxpayer billions. I think, and my guests will keep me honest here, but I think when it was entering into special admin, the estimate was 1.7 billion. But 5 years on, all of that government funding has been repaid, including interest. And that's a remarkably positive outcome from what was a very challenging situation at the time. So it's an unusual and interesting tale, and we're going to tell the story from the perspective of a few of the stakeholders that were involved in it. So today I'm joined by 3 such people. First of all, Steve Cook, a founding partner and head of portfolio management at Sequoia Investment Management Company. They were the secured creditor to Bulb and Simple Energy at the time it entered administration. We have Richard Heis, managing director at Interpath, who was one of the administrators of Simple Energy, and Jamie Murray Jones, who I think this is your 3rd showing on the podcast, senior associate in the restructuring team here at Freshfields, who along with me worked on the Bulb and Simple situation. Welcome to all of you. So to kick us off, Steve, can you start by telling us a bit more about Sequoia and when you got involved with Bulb?
Yeah, absolutely. Thank you. So we were lending out of a listed fund, which full name is the Sequoia Economic Infrastructure Income Fund. But it's such a mouthful, I'll definitely not say that again. We always call it SECI, which is its ticker on the stock market. It's a FTSE 250 fund. It's got about £1.5 billion net asset value. And we make loans into the infrastructure sector globally through a sort of diversified portfolio. And clearly, Bulb was a interesting business to lend into. We made them a series of loans. Over time, the total loan exposure rose to about £55 million. And this was really to enable the company to finance its working capital need, right? One of the challenges that energy supply companies have is that as they grow, but also throughout the course of the year, they end up with very large negative working capital balances. Now, those are eventually going to be collected through bills, but it still needs to be funded. So that was our proposition to Bulb, was we can help you finance your growth. And that was on the back of a business that was very fast growing, had an extremely strong reputation, was being valued by the sort of private equity and venture capital markets in the area of £1 billion or more. And it also fitted very well into our fund's green and sustainability credentials. So Bulb sourced its energy from renewable sources, and that was something that we were keen on, continuing to finance. So that's the original background of our loan.
Yeah, and I think that was the explanation for Boris's presence at the cutting of the ribbon of the new offices, because I think it was very much so viewed as a British unicorn at the time in summer 2021. So Bulb was going from strength to strength in its initial 5 years or so, hit about 1.5, maybe a bit more than that, customers by 2021. But despite that upward trajectory, 2021 was obviously a very difficult year for it as a result of the energy crisis. So Jamie, can you walk us through what happened that autumn after we got involved?
Absolutely. And thank you very much for having me on this podcast again, Lindsay. It's always a pleasure. Bulb faced somewhat of a perfect storm in 2021. Wholesale energy prices spiked that year. They rose as much as 400% during the summer. Bulb, however, was unable to pass those costs on because, as is the case now, there's an off-gem price cap in place, which means that there's a certain limit on how much Bulb and other energy companies could charge its customers. One way that energy companies deal with this is through hedging to ensure that they are not as exposed to the wholesale energy market prices. And this worked for Bulb up to a point, but unfortunately for Bulb, they had an adequate capital to maintain its hedging book as the energy prices and volatility increased. And this then led to a sort of cascade of collapse across the energy market in autumn 2021. All of the other energy suppliers, many of whom, in fact all of whom, were smaller than Bulb, that faced collapse went into a supplier of last resort regime. However, Bulb, facing significant losses as a result of its inability to hedge and the higher costs of energy versus how much it could charge its customers, Bulb was too large for the supplier of last resort regime. And so when all other rescue efforts failed, it entered into the special administration regime with a team at Teneo appointed as the special administrators.
And obviously, special administration regimes are back in the news in the context of the utility sector as we speak. Jamie, can you tell us a bit more about that regime and what it meant specifically for Bulb, noting that whilst we refer to special administration in all sorts of different contexts, actually the regimes differ from sector to sector?
Yeah, exactly. So in this context, we're talking about the Energy Supply Company special administration regime. And as you say, Lindsay, there are a number of different regimes that apply in different industries and businesses, with the thread that unites them all being some extent of public interest and the need to preserve supply as some sort of public service, which means that these industries qualify for that special administration regime. So they are sort of conceptually similar, but actually in terms of how they work, specifically, there can be quite a lot of variation between them. Focusing on the energy supply special admin regime, as already referred to, the primary objective of that regime is to maintain continuity of supply at the lowest practical cost. So that is the key obligation that the administrators have to look to. And in practice, this tends to be supported by significant government funding, as was the case with Bulb, to enable Bulb to continue to supply its customers.
And so, Steve, what did it mean for Sequoia when Bulb entered into special administration?
A few different things. And maybe just to step back for a second, Bulb itself, as Jamie said, went into special administration, but its parent, which was a guarantor on our loan, which is a senior secured loan, went into an ordinary administration. So we had to do a number of things simultaneously. One is clearly consider the mark on our loan, communicate with our investors, update all of our positioning and internal staffing on the loan. That's an internal work stream. We had to make sure we were talking to Teneo as special administrator in terms of trying to protect our position. And we're going to talk a bit more about some of the things that happened immediately after the insolvency. And then we needed, obviously, to focus on recovery coming out of SIMCo. And the reason why that became such a high level of focus is that Bulb itself was cash flow negative. So the government were very clear they were going to put more money in. All of that money would rank senior to us. So the working assumption was that actually we wouldn't see recoveries out of Bulb, but we might see them out of SIMCo going forward.
And so, Richard, you've been sitting patiently there. This was where you came onto the scene as the administrator of Simple Energy. What did the Bulb SAR mean for Simple, and how did you come to be appointed as administrators there?
Sure. Well, thanks for inviting me on the podcast, Lindsay. I'm a frequent listener to podcasts, but not normally a performer. So, yeah, as Steve says, Bulb and Simple were very interdependent. And because it was a fast-growing company, at one stage, I think it was the fastest-growing company in Europe, everything got put together relatively quickly, and as a result, the lines between the two companies were extremely blurred. So although we had different administrators, we basically had two entities that were really totally dependent on each other. So because Bulb went into insolvency, Simple had no choice but to do so as well. And Simple employed the 700 employees. It's owned all the technology, which is the technology, the intellectual property, and the overseas bulbs in France, Spain, and Texas. And Sequoia obviously exercised its remedies and appointed us as administrators under their QFC.
And Steve, I remember that well as we were in court getting the special administrators of Bulb appointed when the news of an out-of-court appointment of Richard and team landed in respect of Simple Energy. What were the considerations from your perspective as creditor around making that appointment at the Simple level?
Yeah, I think there's a few different things. So first of all, we've got a very good relationship with Interpath, right? They're a very trusted counterparty for us. And I felt it was essential, actually, that we had someone who was very aligned with the way we were thinking about how this would proceed post-insolvency. I think we also wanted a fresh pair of eyes and a level of independence, right, in terms of appointing our own administrator. All of these thoughts sort of came together, and we decided it was better to do an out-of-court appointment.
And so, Richard, where that left you was without having really had too much contact with the management team or any of the employees in advance. I think you'd maybe been doing some planning with Sequoia behind the scenes, but you found yourself appointed to Simple Energy. How was that from your perspective? How did you approach day one, as we often call it, of the administration?
Well, it wasn't made easier by the things you mentioned, Lindsay. It was a sudden appointment, and notionally it was a hostile appointment because it wasn't really part of the plan. But it was very important that it wasn't seen as hostile, particularly by the employees, because the employees were very important to this, and maintaining the goodwill and the culture amongst the employees was extremely important. So although there was, I would say, a lot of surprise, that settled down very, very quickly. And it was very important that the Teneo administrators and ourselves were seen as aligned with them, between ourselves and also with management. And that was actually the case. Everybody finished each other's sentences perfectly well. We all actually got on very well personally. And that was very important because people can perceive tension, and we fortunately avoided that and kept the wheels on the wagon with the employees very successfully. And I would say in insolvency, as we all know, you see people at their best and their worst. It so happened they were really excellent people, and throughout the organisation that helped maintain the stability the company needed.
I seem to recall you were quite quickly out of suits and into T-shirts to fit with the dress code of the company and the employees, if I recall correctly.
That was one of the rules, and we were ticked off initially about that, but we got with the programme quite quickly.
You have to fit in. Turning then to one of the major work streams that we were dealing with at the outset of the administrations, and that was around the negotiation of the transitional services arrangement between Simple and Bulb, which kind of goes back to those interdependencies that you were talking about, Richard. So, Jamie, maybe coming back to you, can you explain what that entailed and why it was needed?
Yeah, absolutely, Lindsay. And as you've said, and indeed as Richard has said, the key point here is that Bulb and Simple were very interdependent with one another. Bulb had the customer book, Simple had the tech and the employees. And so they sort of needed each other to function properly. And at the same time, because this business had grown up so quickly, and in fact, in fairness, this isn't unusual in our experience with corporate groups, there wasn't a formal or documented intergroup arrangement between Simple and Bulb that governed how the supply of services between them would operate. And that was all fine and dandy while these two entities were out of insolvency and operated together. But once they were both in insolvency and operating as separate estates with separate office holders from Teneo and from Interpath, each of whom had different duties to different stakeholders, etc. At that point, it then became necessary to ensure there was a proper arm's length negotiation to regularise the position and put in place some formal arrangements.
Yeah, and I guess it's worth noting that it's something the regulators looked at subsequently, because actually looking at the regulated entity being in a position where actually that regulated entity in special administration didn't have access to everything it needed to continue that supply, which, as we said earlier, is the key purpose of the special administration, was probably in retrospect a bit of a flaw in the way the regulation was set up. But coming back to the TSA, Richard, anything to add in terms of the approach to the negotiation of that, which, as I say, was very much so one of the first things on the to-do list at the outset?
Yeah, no, exactly. It was probably one of the very first. And it was complicated because it's the cost of the services, but also the value of the services, which was really enormous because the services were indispensable and couldn't be replaced within any kind of realistic timetable. So it was very much a question of trying to strike a fair balance without making it look like a sort of ransom type situation, which certainly would not have been helpful to the wider picture, but making sure that there is realistic payment for the very valuable services that were being provided. So I think broadly that was the result that was achieved. It was a fair price. It was expensive, but the services were valuable. And we did a number of independent analyses. We looked at analogies with certain other kind of companies who were making third-party provision, and we put forward a series of calculations, and on that basis, Teneo and ourselves agreed a fair price. And one thing that was interesting was because of the unique culture of Bulb and the need to make sure the employees felt that they're young, they're idealistic, and they had a unique culture. And we'd actually put in the TSA, if there are payments needed, to preserve the culture and to put on events and make people feel good about working for Bulb, then that was something that was payable under the TSA, which was probably quite helpful.
Yes, and probably not always that common for a trading administration, but as you say, quite an unusual situation here with that focus on continuing supplies, which very much so required the employees to remain motivated.
Yeah.
And then one of the other big work streams at the outset was what to do about the international subsidiaries. You alluded earlier, Richard, to Bulb France, Bulb Spain and Texas, all of which were dependent on the UK mothership and so were themselves put in a difficult position when the UK companies filed. What happened to them in the end?
Different things. The French company went into administration or liquidation in France. We had an interesting early decision because the company was a participant in the French nuclear program, which gave you cheap electricity, but you had to effectively make a series of commitments, which we were not in a position to make. So sadly, that went into liquidation. We appointed new directors to the Spanish and the Texan companies in the form of Martin Cook, and those were stabilized pretty well, pending a sale, which was done in a couple of months, I think a month for Spain, which is a lot of work for all of us, and then Texas a little bit further down the track.
And so after that initial stabilisation period, then the focus turned to asset realisation, which, as you say, Steve, was the main focus of the appointment at SIMCo. Richard, what were the main options that you explored for that?
Well, we had a joint sale process between SIMCo and Bulb for obvious reasons. They were still very connected. And our principal objective was to achieve a sale to a single buyer, which would obviate the need for the TSA. And there would be obviously an argument about value allocation within that. That seemed like a reasonable route to go down. Because the buyer was actually Octopus, who obviously have their very well-known high-tech solution in the form of Kraken, they did not require the Bulb technology. So for two reasons, we needed to preserve the value of that technology. We needed to seek an independent sale of a split-out technology business using the TSA to effectively ensure all of the technology was contained within our control in SIMCo. And from the point of view of the employees, it was very important that they could see an exciting, positive future, because the idea of being a residual supplier of services to Octopus until they were replaced, that's not an attractive position for motivated, energetic employees who are in high demand. So we needed a positive alternative outcome for them, and no doubt that will be talked about further.
I have to say, I really loved working on this transaction because it just felt like a really positive thing to be effectively spinning off a new startup effectively in the form of a new tech company out of the administration. So Jamie, maybe you can tell us a bit more about what it entailed.
Yeah, absolutely. I couldn't agree more. It was genuinely quite exciting to get to work on starting a company up rather than, as sometimes happens for us, working with companies at, should we say, the other end of their life cycle. The actual spin-off itself was quite complicated in some respects. What we were ultimately looking to achieve was to get the relevant assets, e.g. the IP and the tech, along with the employees needed and other things necessary for the business, into a clean box, clean corporate entity that could then be neatly separated from the simple group and could ride off into the sunset and have this happy future. And I'm not going to go into sort of all the intricacies because it was quite complicated to structure, but I think it's worth noting we had to think quite carefully about a number of operating concerns. So, for example, ensuring that this new entity would have premises out of which to work, and also ensuring that it had funding to keep it going, to keep the employees paid, etc. That involved a wide variety of complicated issues, as well as involving teams from across Freshfields, including our IP teams and our employment teams and our tax teams. Just cutting a long story short, we were successful in having down the entity, and it was then capable of being sold cleanly to Sequoia, which I think led to a positive outcome for the SIMCo estate.
So that was in 2022. What has happened since, Steve?
Yeah, so it's been a very interesting investment for us, because obviously our main strategy, as it were, is lending to infrastructure projects which are income generating and asset backed. And at the end of the day, Zoa, which is the name of this technology platform, was really a venture capital investment, high growth, but definitely not an infrastructure asset. So it was an atypical investment. We're very keen to do it, though, for two reasons. First of all, it was a very good team. They had over 100 developers, and they'd built some really cutting-edge technology at Bulb, right? So they had some of the very early AI systems for answering customer emails, for example, amongst other things. And secondly, we thought, actually, when we look at the whole of the utility sector in the UK, it's categorized by having actually very poor systems quite often, right? Poor customer experiences. And our view was actually technology could help to fix that. So we actually worked with manager, and we slightly repositioned the business away from being a utility-focused business to a sort of smart home business, right? So in other words, developing systems that enabled the different energy products that you might have in a home, so panels, electric car charging, heat pumps, etc., to talk to each other in a smart way. And I think that was very successful. It was quite innovative, quite cutting edge. And in the end, we sold the whole business to Centrica, which obviously was therefore an exit for us from our venture capital experience.
So in parallel to all that, Bulb was progressing its own asset realisation programme. So the sales process that you mentioned earlier, Richard, resulted in a sale of the customer book in late 2022 to Octopus, so around the same time that we were setting up Zoa. Octopus happening to be another key client of Freshfields, although we weren't acting for them here. I think the really key thing to understand in order to understand the outcome of the overall case is one of the terms of that deal was that Bulb agreed to continue purchasing energy on the wholesale market for the ex-Bulb customers during the winter of 2022-2023 following the sale. And in return, Octopus paid Bulb an amount reflecting the then current price cap of Ofgem. So that was a good deal for Octopus because they were benefiting from a fixed price and the knowledge that they wouldn't end up paying more in wholesale than they could receive back from customers. But as it transpired, it was also a very good deal for Bulb because that was the only time in, I think, 2 or 3 years that wholesale prices actually dropped significantly. And what that meant was that the wholesale price was a lot less than the customer price cap. And that arrangement was therefore very profitable for Bulb.
Overall, it was actually a very, very positive experience. So, first of all, there was really no disruption to customers. I mean, certainly going into this, we were obviously concerned we'd see a lot of customers leave the business. You know, it would diminish the value of the customer book. You'd see a high level of customer churn, as they call it. In fact, that was really minimal. I think in part that was because of all the work that SIMCo was doing to sort of maintain the customer experience there. So, first of all, no real disruption to customers, to energy users. Secondly, the government funding, as you said earlier, was fully repaid, including interest, which incidentally was at a much higher interest rate than government borrows at. So it was a higher than gilt rate. So in a sense, the government made a profit on the whole transaction. Thirdly, we were fully repaid, including our interest and actually virtually all of our expenses. I ought to add into the conversation actually that we were supported through this by Watson Farley and Williams, who did a fantastic job on this complicated deal. And then fourthly, as I understand it, there's still residual assets left within SIMCo, which Rich and his team have been liquidating, and that's resulted in the unsecured creditors of SIMCo, of which there weren't a huge number, all being paid off, and actually distributions being made to preferred equity investors.
So a really fantastic outcome, and I think not what we were all expecting back in November 2021, it's fair to say. Richard, in your view, how was it achieved?
Well, first of all, the SAR did what it was supposed to do, which was great because the customers did not have any sort of detriment, because at the time a lot of other energy companies were loath to take on other customers. That actually helped the stability of Bulb's customer base. But one interesting thing, I mean, you were talking, Lindsay, about other special regimes, and they are all different. And one difference between that and the things that I've done a lot of is the financial regime, where you have no creditor worse off, and we don't have that. And that's a point that Steve referred to in terms of being primed by the new debt coming in. So although Bulb was the borrower, the priority rules under the ESC administration meant that Sequoia's value was focused on the performance of the simple administration, or so we thought, because when the dramatic movements in energy prices occurred, it resulted in the waterfall payment that came from Bulb, and that effectively provided a very pleasing subrogated loan recovery for us, for the money that we'd paid Sequoia. So it was essential that the various stakeholders' interests were protected. The sale to Octopus obviously resulted in positive results, but also challenges in terms of them not taking over the technology. But clearly there was a solution to that. And I think it was quite helpful to have an innovative transaction to hive down the technology function into a standalone company. And I think a lot of people played a very worthwhile role in achieving that result.
Thanks, Richard. So, Steve, any final reflections from you on navigating Infra insolvency from an investor's perspective, although I'm sure it's not an experience you're looking to repeat anytime soon?
No, hopefully not. But I think there are some takeaways. So one is having a strong relationship with the administrator or the equivalent in different jurisdictions. I think it's very important to be hand in glove and for each party to understand the other's motivations and perspectives and requirements through the process. Secondly, I think creativity is very important, right? So things like creating Zoa, but also how we thought about some of the other assets that could be liquidated within SIMPL. It can add a lot to the outcome, right? You don't need to just follow the playbook. You can think, as it were, outside the box. And thirdly, being patient and also tenacious is really important. These things take a long time, high level of legal and financial complexity. It's not easy to do things like realize value from the sale of Bulb's assets in Spain or Texas. You know, there's a lot of legal complexity working through the sort of interplay between the special administration and the ordinary administration. But if you hang on in there and you work it, you can actually get very good outcomes.
Well, you certainly were very tenacious, Steve. So look, I just want to take the opportunity really to say that we really loved working with you both on this case and really delighted to see such a positive outcome. Thank you so much for joining us today to run through it all. And thank you for listening. Please do tune in to the next episode of the podcast.